Okay, let's dive in. Welcome everyone to the Deep Dive. Today we're really unpacking the Q2 2025 earnings call for Global Medical REIT, that's GMRE, which happened back on August 6th. If you follow healthcare real estate, you know this is pretty timely. GMRE, it's a net lease REIT, and well, they're navigating some serious changes, a big strategic reset amid sector headwinds.
That's spot on. I mean, GMRE is facing a couple of big pressures simultaneously. You've got the higher interest rates squeezing valuations across the board for REITs, and then you have this CEO transition. The new CEO, Mark Decker Jr., he's been very clear. The mission right now, it's really about cleaning up the balance sheet. Think capital discipline, selling assets, what they're calling capital recycling.
Right. So this call felt less about celebrating Q2 performance maybe and more about laying out that future roadmap. But we should start with the headline numbers because they do tell part of the story.
Absolutely. And they were pretty much textbook on the earnings side. Non-GAAP FO per share, $0.20. Non-GAAP AFFO per share came in at $0.23. Both of those were right in line with consensus estimates.
And just quickly for listeners, FFO and AFFO, those are the key cash flow metrics for REITs, right? They tell you about dividend sustainability.
Exactly. Funds from operations and adjusted funds from operations. Crucial numbers.
Okay, but where they really stood out was revenue. They hit $37.9 million. That actually beat the consensus, which was around $35.6 million. That's, what, over 10% year-over-year growth. Pretty strong.
Yeah, 10.7% growth. It looks good on paper. But, what's really telling is how the market reacted or maybe didn't react. Despite meeting or, beating expectations, especially on revenue, the stock actually dipped a bit, maybe 2 to 3% around the call.
Okay. So strong numbers, but the stock goes down. What does that signal?
It tells you investors weren't really focused on the Q2 operating metrics. Their eyes were squarely on the company's debt levels, the leverage, and how clear and convincing that strategic plan was under the new CEO to tackle the debt. That was the real story.
That makes sense. And it leads us right into the strategy piece. The new CEO, he laid out 3 immediate priorities. One was just getting the team and board aligned on strategy, but the other 2 were, well, pretty concrete.
Very concrete. First, complete the refinancing of their main credit facility. That's the revolver and a big $350 million term loan that's due in 2026. That's critical. Second, execute that capital recycling program. Sell assets to raise cash.
And the goal for all this activity?
It's all about getting a stronger balance sheet now. Building capacity so they can actually grow later when conditions improve. Management explicitly stated the target, get leverage down below 40%, or if you look at debt to EBITDA, below 6 times.
Okay, below 6 times debt to EBITDA. Now, you mentioned they view their preferred stock differently, right? Like it's more akin to equity. How does that factor into the calculation?
Yeah, that's an important nuance. When they calculate that sub 6 times target, they are not including the preferred stock in the debt figure. It's really a signal to credit markets. Preferreds are technically ahead of common equity, but by treating them like equity for this leverage calc, management is trying to make their core bank debt and bonds look, well, cleaner and more manageable, especially ahead of that big refinancing effort they're aiming for in Q4.
Got it. It's about managing the optics for the lenders.
Yeah.
Okay, let's shift to operations, the actual buildings. Occupancy was 94.5% at the end of June.
Right. And the big win operationally was definitely the re-tenanting success down in Beaumont, Texas.
The Christus Health lease. Tell us about that.
Yeah, huge deal. It's about 85,000 square feet. And Christus Health fully commenced their lease in May. This single lease is a big deal for them. It brings in about $2.9 million in first-year rent, and it has 2.5% annual bumps baked in. Really solidifies that asset.
Okay, so if they had that big win, why did occupancy dip slightly to 94.5%? Were there issues elsewhere?
There were. It seems mostly driven by 2 specific move-outs. One was in Aurora, Illinois. The other is a bit more complicated, tied to the Prospect Medical bankruptcy, affecting their property in East Orange, New Jersey. That one was only about 40% occupied.
Oof. Bankruptcy situations can be messy. What's the plan there?
Well, the positive is that management feels they have better control over that East Orange space now. They actually sounded pretty optimistic, aiming to get that property back above 90% occupancy, over the next 2 to 3 years. 24 to 36 months was the time frame mentioned.
Ambitious timeline given the bankruptcy context, but definitely something to watch. And despite those issues, they're guiding for full-year occupancy to finish over 95%.
Yeah, that's what they reaffirmed. which suggests confidence, probably linked to stabilizing East Orange and maybe their ongoing acquisition activity too.
Let's talk acquisitions then. They seem to be finding deals.
They certainly are. They closed a 5-property portfolio during the quarter, spent about $69.6 million. And the really interesting number there is the cap rate, around 9%.
9% in this market. That sounds quite high for like institutional quality medical office.
It is high. And it points to their strategy. If you look at their total acquisitions over 2024 and 2025, it's about $150 million altogether. And the blended cash yield is around 8.5%. Management keeps stressing these are like differentiated deals. They're buying them well below what it would cost to build new.
Okay, below replacement cost, high yield.
Yeah.
What's the catch? Or what's the unique angle?
The really interesting part, I think, is their claim that the rents currently being paid at these properties are potentially 30% below market rates.
Whoa, 30% below market. Okay, that's huge potential. That means they aren't just relying on rent bumps or inflation for growth.
Yeah.
They're basically buying built-in upside.
Exactly. If they're right, as leases roll over, they can mark them up significantly towards market rates. It creates this powerful sort of internal growth engine. They seem to be targeting properties maybe owned by folks who bought with cheap debt a few years ago and are now maybe feeling the pressure. GMRE steps in, maybe takes on some leasing risk like in Beaumont, and aims to capture that rent upside.
Provided they fix the balance sheet first.
Provided they fix the balance sheet. Which brings us neatly to capital discipline. Finding these 9% cap rate deals is great, but you need cash. And that led to probably the toughest news on the call, the dividend cut.
Right. They lowered the quarterly payout from 21 cents down to $0.15 per share. That definitely stings for income investors.
It does. But management called it right sizing.
Yeah.
And look at the impact. The FAD payout ratio, that's funds available for distribution, basically cash flow coverage for the dividend, it dropped from an unsustainable 110% down to a much healthier 79%.
So less cash out the door as dividends means more cash for.
Right.
Debt pay down, reinvestment.
Both, potentially. The cut frees up about $17 million a year in cash flow. That cash can go straight to paying down debt ahead of the refinance, or it can be plowed back into buying more of those high-yield properties we talked about. And to underscore this focus on capital allocation, they also announced a $50 million share buyback program right after the quarter ended.
Ah, the buyback. That signals they think the stock is cheap, right? And now they actually have some cash to potentially act on it.
Precisely. It's all part of the same narrative. Discipline, flexibility, focusing on total return, not just the dividend yield.
Okay, let's zoom out again. Macro picture. Rates are higher, maybe for longer. That pressure's all REITs. For GMRE, you said the cost of capital is the big near-term hurdle.
Absolutely. Can they execute that crucial refinancing in Q4 this year, given where rates are? That's the main question. Remember, they need to deal with that 2026 maturity, the revolver, and that $350 million term loan. Getting it done by Q4 2025 is the target.
Why Q4? Why not sooner? Or maybe wait a bit longer?
Well, the timing seems linked to their asset sale plan, the capital recycling. They're actively looking to sell between $50 million and $100 million worth of property. And interestingly, they said they want to sell their best assets, the ones with great tenants, long leases, the stuff that's likely to get good bids even in this market.
Sell the good stuff. That seems counterintuitive.
It does at first glance, but the logic is probably sell what you can sell quickly and at a decent price right now. Use that cash immediately to pay down debt. That makes the remaining debt easier and likely cheaper to refinance in Q4. It de-risks the process.
Okay, that makes sense. De-risk the refi first. But even with that, the new debt is almost certainly going to be at a higher interest rate than their existing facility, isn't it?
Oh, almost certainly. Their current rate is likely quite low, locked in years ago. But despite expecting higher interest costs, management reaffirmed their full year 2025 AFFO guidance. They kept it at $0.89 to 93 cents per share.
So they think they can absorb the higher interest expense.
Their confidence seems to come from a few places. Those built-in rent increases in their existing leases, the full year impact of that big Beaumont lease kicking in, and the earnings contribution from those high-yield acquisitions they've already made. They believe those positives will offset the drag from higher interest payments. Hitting that guidance range would be a major proof point for their strategy.
And the long game isn't just refinancing this one facility, is it? It's about changing how they fund themselves overall.
Exactly. The goal is to really utilize an unsecured balance sheet structure more effectively, diversify their lenders. They mentioned wanting to bring in longer-term debt providers, like insurance companies, not just rely on banks. That generally means more stable funding, better access to capital down the road.
Okay. We've hit the results, the strategy, the risks, the potential upside. It feels like time for our, let's call it our idea segment, a specific trade concept. Always remembering, of course, this is absolutely not financial advice, just brainstorming.
All right, let's call this one the leverage cleanse arbitrage.
Leverage cleanse arbitrage. Okay, lay out the thesis.
The core idea is that GMRE has already taken its medicine, so to speak. They did the painful dividend cut. They announced the buyback. They have a very clear plan and timeline for fixing the debt situation by Q4. The stock price is still depressed, probably dragged down by general negativity around smaller REITs and, the dividend cut itself. It's underperformed peers this year. But the internal cleanup is well underway.
So the bet is that their proactive steps haven't been fully recognized yet. How do you structure the trade?
The trade idea is go long GMRE. The rationale is that the improved dividend coverage, that 79% fatty payout, and the clear refinancing plan creates something of a floor under the stock price. Then you hedge that long position. You could short a basket of other small cap healthcare REITs that maybe haven't been as aggressive in fixing their balance sheets yet, or maybe just short a broad real estate ETF like XLRE.
Okay, so long GMRE, short peers, or the sector. What's the catalyst? What makes GMRE outperform?
The catalyst is the successful execution of that Q4 debt refinancing. If they get that done, ideally on reasonable terms, the market should reward them for cleaning up their house. The bet is that GMRE starts to decouple from peers still wrestling with high leverage or uncertain dividend coverage. It's basically a bet on management execution and the market rewarding balance sheet discipline.
Interesting. A bet that the market eventually values the cleanup more than the temporary pain of the dividend cut. Okay, so wrapping this up for you, the listener. GMRE delivered results that were basically in line, maybe slightly better on revenue. But the real focus here, the whole story, is about executing the strategic plan.
Yeah.
Fixing the balance sheet, hitting that 95% plus occupancy target.
Right. And maybe the final thought to leave you with is this. Management keeps talking about buying properties with rents 30% below market. They define quality not just as shiny buildings, but as better risk-adjusted returns, meaning those higher cap rates they're finding. So the real question is, how much organic growth potential is actually baked into this portfolio now? And crucially, will the market start pricing in that potential before or only after they successfully refinance that debt in Q4 or early next year? That hidden rent growth could be the real engine here.
A very provocative question indeed. That organic growth lever is certainly something to think about. Well, thank you for joining us on this deep dive into GMRE's Q2 call and their strategic pivot. As always, we encourage you to dig deeper into the materials yourself. We'll catch you on the next one.